Hi everyone, and welcome back to Next Generation Business School, where we empower future leaders in business and finance. On this channel, we dive deep into accounting principles, tourism accounting, financial management, business strategies, and economics insights. Stay tuned and let's unlock top strategies to help you excel in your studies and also your future careers. And please don't forget to like, comment, and subscribe for more valuable contents. Please remember, every expert was once a beginner, and with the right knowledge and determination, definitely you can achieve greatness. Your journey to success starts here, so let's get started together. Okay, today we want to start this lecture with the taking physical inventory. So, in these topics, taking a physical inventory, we want to know what is the taking physical inventories and why it is important. So conducting a physical inventories is important practice for businesses, even if you use a perpetual inventory system where inventory records are continuously up to date with each purchase and sales. A physical accounts help verify the accuracy of these records. For example, let's say you run a tourism business that rents out camping equipments, and throughout the year, your perpetual inventory system tracks each item going in and out. However, you still need to conduct the physical counts maybe quarterly or annually to ensure these records match the actual items on hand. So why this activity is important? Because of accuracy and loss preventions. A physical counts ensure that your inventory records reflect reality, and it helps identify any discrepancy due to loss, theft, or errors. And understanding the shrinkage in the inventory is also refer to difference between the recorded inventory in your books and actual physical inventory count. This discrepancy can arise due to various factors such as theft, damage, and clerical errors. For example, imagine you recorded 100 camping tents in your system, but during the physical counts, you only find 95. And this difference of 5 tents is inventory shrinkage. Minimizing the shrinkage is also important. While businesses strive to minimize shrinkage through the better security, training, and accurate record keeping, it is generally accepted as a normal cost of doing business. So what is the best practices to prevent it? First is regular physical counts that includes scheduled periodic inventory accounts to catch discrepancies early. Second is improved security, that is use security cameras and restricted access areas to prevent debts. And third is employee training, that is educated staff on proper handling and recording procedures. So, conducting the physical inventory counts and understanding inventory shrinkage are essential practice for maintaining accurate inventory records and minimizing losses. In fact, by implementing these practices, business can ensure their inventory management is as efficient and accurate as possible. Okay, in the next topic, we want to discuss with together some important and famous example of inventory shrinkage. These famous examples includes breakage, spoilage, theft, and administrative error. Let's start with the first one, breakage. Breakage refers to items that are damaged during the handling, storage, or transportations. For example, imagine you own a tourism equipment stores, and during the process of moving camping gear from the warehouse to the storefront, a few things get torn or poles get bent, and these damaged items are considered inventory shrinkage due to breakage. The second example is spoilage. Spoilage occurs when perishable items deteriorate or become unsellable. For example, if you run a travel business that also sells the package food items for campers, some of these food items might spoil before they are sold. For example, if you have a batch of a trail mix that expire before it can be sold. This spoilage contributes to inventory shrinkage. The third famous examples of inventory shrinkage is theft, and it includes both external theft, for example, shoplifting, and internal theft, for example, employee thefts. And let's see the example we together. In tourism stores, for example, the customers might steal high value items like as GPS device, or an employee might take cash from the register. Both scenarios contributes to inventory shrinkage through theft. And final famous example of inventory shrinkage is administrative errors, where administrative errors, mistakes made in recording inventory transactions such as incorrect data entry or miscounts. So, for example, if you and employees and you accidentally records of 50 units of camping gears received instead of 40, the system will show more inventory than actual exists. And this discrepancy due to clerical mistakes is considered inventory shrinkage from administrative errors. So as a conclusion, understanding these examples of inventory shrinkage, breakage, spoilage, theft, and administrative errors can help you identify where losses might be occurring in your business and take steps to minimize them. Okay, this is a time to discuss for tourism related business conducting regular physical inventory counts that is essential for several reasons. So why this physical counting of inventory is important? There are four reasons, and the first one is accuracy verifications. Conducting regular physical inventory counts help ensure that your inventory records accurately reflect the actual inventory on hand. For example, imagine you run a camping gear rental business, and throughout the year your inventory system tracks all the tents, sleeping bags, and other equipments. However, periodically counting these items physically verifies that your records match the actual stock. And this accuracy is crucial for knowing exactly what you have available for your customers. The second reason is loss preventions, and regular physical counts help identify discrepancies, allowing business to investigate and take corrective action to prevent future loss. For example, during the inventory counts, you might discover that some items are missing, and this could be due to theft, damage, or administrative errors. Identifying these discrepancies early enables you to investigate the causes and implement measures to prevent similar losses in the future. The reason number three is compliance and reporting, where conducting periodic physical inventory counts ensures compliance with accounting standards and regulatory requirements. For example, accurate inventory records are not only important for internal management but also for external reporting is important. In fact, regulatory bodies and accounting standards require business to maintain accurate records, and regular physical counts help ensure that your records comply with these requirements and avoiding potential legal issues. And final reason is planning and decision making. Physical inventory counts provide reliable data for inventory management and strategic planning processes. For example, reliable inventory data is essential for making informed business decisions. For instance, if you find that certain camping items are frequently rented out and others are rarely used, you can adjust your inventory purchases accordingly. And this data driven approach helps optimize your stock levels, reduce cost, and meet customer demand more effectively. Overall, conducting the regular physical inventory counts is essential for tourism related businesses, and it ensures accuracy, prevents losses, ensure compliance, and provide valuable data for planning and decision making. Okay, before continuing to analyzing the economic scenarios with together, we want to discuss with together about the two important inventory management methods: periodic inventory management and perpetual inventory management. Until this moment, we have some explanations about them, but now this is the time to have explained them separately for better and deep understanding, and again continue our journey to economic events and discuss these two different inventory management methods from different aspects. So let's start with the periodic inventory systems. In periodic inventory management, business conduct physical inventory counts at the regular intervals, such as weekly, monthly, or annually. And recording transactions in periodic inventory systems and sales are not recorded in real time. Instead, they are aggregated over the inventory periods. We will see here in the example in next part of the lectures. And also, cost of goods sold calculations in the periodic inventory management is calculated periodically by subtracting the ending inventory from the sum of the beginning inventory and purchase during the periods. So, what is important key point about the periodic inventory system? It is that the physical inventory counts in the periodic inventory system take place in regular intervals. In the perpetual inventory system, the next methods, we track the inventory levels continuously and up-to-date records in real time as goods bought or sold. And recording transactions in the perpetual inventory systems is such as purchase and sales is recorded immediately, and providing up-to-date information on inventory quantities and values. The benefits of perpetual inventory systems is that it offers real-time visibility into inventory levels and helping business make timely decisions and prevent stock outs or overstocking. So in the perpetual inventory system, the physical count take place in the key terms of continuously. So just is required to remember these two key important part for finding and understanding the difference between periodic and perpetual inventory system. In periodic inventory system, the physical counts take place in regular intervals, but the perpetual inventory systems, the up-to-dating of the informations about inventory take place continuously, and always we have up-to-date informations about our inventory. So according to the explanations in past part, we want to have one economic records analyzing about the perpetual inventory systems. Look at to the economic scenarios. On December 31st, Adventure Tour conduct a physical inventory counts and discover an inventory shortage of 1,500. So we are acting under the perpetual inventory system. And as we know, the perpetual inventory systems track inventory levels continuously and up-to-dating records in real time as goods are bought and sold. Okay? So, when the inventory is missing or shrinkage take place or identify, we should use two accounts. First, the cost of goods sold, and the second, the inventories. This shrinkage take place or find in the December 31st, and we have two account: cost of goods sold and inventory. In the cost of goods sold, because this shrinkage is known as the additional cost. It's increased the amount of cost of goods sold. The cost of goods sold is considered as debit, and the amount of shrinkage is 1500. So 1500 debit for cost of goods sold. And also this shrinkage means that the total level of inventory is decreases by 1500, and decrease in inventory is known as a credit because inventory is belong to assets and accounts that are belong to assets. The decreases is considered as credit. How much? 1500. Okay, again, in the periodic inventory system, we where business are up to date their inventory and cost of goods sold accounts only periodically and typically at the end of the specific accounting period, such as monthly or annually. This up to date of inventory take place. Unlike the perpetual inventory system, which tracks inventory levels continuously, the business using the periodic inventory systems conduct physical inventory counts to determine the quantity of goods on hand at the end of accounting periods. And under the periodic inventory system, the cost of goods sold is calculated periodically and usually at the end of the accounting periods based on the opening inventory balance, purchases made during the periods, and ending inventory value derived from the physical count. Look at to the one economic scenario in relation to periodic inventory system. So under the periodic inventory system, on January 6, Adventure Gear Store purchased camping equipment accounting to 2,500 on account from Outdoor Supplies Corporations. So how we can record these economic scenarios under the periodic inventory system? So as we know right now, in the periodic inventory system, the amount of inventory is up to date periodically, not perpetually. So there is no entries made in inventories. Instead, we use purchases because we are acting under the periodic inventory system. So the purchases is a type of the cost and it's become debited by 2,500. Purchase increase, and we behave with purchases like cost is become debited by 2,500, and also account payables is increases because account payable is showing the liability of a business is belonging to the liabilities, and increase in liabilities sub accounts that accounts payable also included is 2,500 credit in this case under the periodic system. And as you can see in the periodic inventory system, there is no entry made in inventory. Instead, we use purchases. If we act under the perpetual inventory system, we use inventory instead of purchases. But in this scenario, when we use periodic inventory system, we use the purchases account. Okay. The one of important characteristics of periodic inventory system is cost of goods sold calculations. In fact, as we discussed with together in previous slides, the cost of goods sold in the periodic inventory system is calculated periodically by subtracting the ending inventory from sum of beginning inventory and purchases during the periods. So here we want to compute cost of goods sold using some simple accounting recourse. And this is essential skills for everyone looking to understand the basics of business finances. Let's dive right in. So understanding the basics, cost of goods sold is the total cost of manufacturing or purchasing the products that our company sells during the specific periods, and it is important figure because it directly impact the company profitability. So again, cost of goods sold is the total cost of manufacturing or purchasing the products that company sells during the specific periods. Here there is some information we have. First, beginning inventory at the January. First, beginning inventory at the January 1st equal 14,000. This is the inventory that we had at the start of the years, and in our example is equal 14,000. Beginning inventory. In the first January, $14,000. Purchases during the year is the next element, and this is a total amount spent on purchasing new inventory throughout the years, and in this example is equal $130,000. And finally, we have ending inventory on December 31st, and this is the inventory we have left at the end of the years, and this example is equal $12,000. So step-by-step calculations of final cost of goods sold. First, we need to calculate the cost of goods available for sales. For this purpose, to finding the cost of goods available for sales, first we need to add beginning inventory to the purchase made during the years. So the beginning inventory purchases during the years plus the purchases that take place, 14,000 plus 130,000 equal 144,000, the cost of good available for sales. In the next level, we need to subtract the ending inventory from the cost of goods sold available for sales. So ending inventories or inventory at the end of the years, 12,000, should be deducted from 144,000 cost of goods available for sales. So 144,000 minus 12,000 equal 132,000. And finally, we started with the inventory of 14,000 at the beginning of the years, during the years, and we purchased additional 130,000 worth of goods. And this gives off a total 144,000 worth of goods available for sales. And after accounting for the $12,000 worth of inventory we still have at the end of the years, and we find that the cost of goods sold is $132,000. This is the procedure for computing cost of goods sold in the periodic inventory systems, where we calculate it regularly in special intervals during the accounting periods. But after explaining about the difference between perpetual inventory system and periodic inventory systems, this is a time to discuss with together which factors are influence the choice of perpetual and periodic inventory systems. So let's start with the factors that suggesting a perpetual inventory system. First, the large company with professional management. In fact, the perpetual inventory system is more suitable for the large company with professional management because the perpetual inventory system is ideal for large companies with professional management teams, and it offers a real-time visibility into inventory levels and allows for better decision making based on accurate data. The desired for detailed informations. So when management and employees wanting information about the items in inventory and quantities of specific products that are selling, the perpetual inventory system is more suitable. In fact, management and employees who want detailed information about the items in inventory and quantities of specific products that are selling will benefit from the perpetual inventory system because it provides instant access to inventory data and include product details and sales trends. The next item is items in inventory with higher per unit cost is where the perpetual inventory system is preferred. If your inventory includes items with the high per unit cost, such as electronics or luxury goods, a perpetual inventory system can help prevent costly stock outs or overstocking by providing accurate inventory tracking. After that, the low volume of sales transaction or computerized accounting systems are offered to using perpetual inventory systems because a perpetual inventory system is well suited for businesses with a low volume of sale transaction or those already using the computerized accounting system is seamlessly integrates with existing softwares and ensure accurate recording of inventory movements. And merchandise stored at multiple location or warehouse separated from the sales sites are offered using the perpetual inventory systems because for businesses with merchandise stored at the multiple locations or in the warehouses separate from the sales sites, a perpetual inventory system offers centralized control and visibility, and it enables efficient management or inventory across various locations, reducing the risk of stock discrepancies. So, implementing a perpetual inventory system offers the numerous benefits, including improved accuracy, enhanced decision making, and streamlined operations. Whether you are a large corporation or a small business, considering these factors can help you determine if the perpetual inventory system is the right choice for your organization or not. In the next level, we want to discuss with together the factors suggesting a periodic inventory system. The first factor is small business relied by owners. For small businesses operating by owners, a periodic inventory system can be more practical. It is simplifies inventory tracking and reduces the administrative burdens and allowing the owners to focus on other aspects of running the business. Accounting records of inventories and specific products sales not needed in daily operations are offered to using periodic inventory systems. In fact, in this part, we need minimal for detailed records. If our daily operations don't require detailed accounting records of inventories and specific product sales, a periodic inventory system may be sufficient and it streamlines the inventory management process, saving time and resources. The third factors that suggest a periodic inventory system is inventory with many different kinds of low cost items. So when all items are low cost. Business with inventories consist of many different kinds of low cost item can benefit from periodic inventory system because it provides a simplified approach to inventory tracking, especially when items don't individually justify the cost of continuous monitoring. The next factors that offers a periodic inventory system is high volume of sales transaction and manual accounting systems. In this situation, where the high volume of sales transaction and manual accounting system is placed, a periodic inventory system can be more manageable because it reduces the complexity of recording inventory movement and align with manual accounting processes. And finally, where our merchandise is stored at the sales site. If the company is stored at the sales site, a periodic inventory system offers a straightforward solutions because it eliminates the needs for remote inventory tracking and ensure that inventory counts can be easily counted on site. So, choosing periodic inventory system can be advantageous for small businesses with limited resources, minimal needs for detailed records, and inventory comprises of low-cost items. And consider these factors when determining the best inventory management approach for businesses.